The place of technical analysis was always a very much debated one in the finance world. Some traders like Paul Tudor Jones, Ed Psychota, or George Soros like it and used it. But others say that it's pretty much like astrology that doesn't work. In the old days, traders like Jesse Livermore made a name for themselves by being able to read the tape better than most people and made fortunes with it. Times have changed since then, but there are a lot of videos about trading strategies heavily relying on technical analysis even in 2024. I have two questions here. What do institutional traders or hedge fund managers think about technical analysis, and how did technology change it? Will it become completely obsolete, or is it something that will have a place in trading and investing? Technical analysis is like reading the tea leaves of the stock market. It's a method of analyzing securities by evaluating historical price and volume data to predict future price movements. Imagine you're Sherlock Holmes, but instead of solving crimes, you're solving the mystery of stock prices. Traders use charts, patterns, and indicators to identify trends and patterns, much like a weather forecaster uses radar to predict storms. It's not about the company's financial health or the CEO's charisma, but rather about deciphering the language of the market itself. Think of it as the art of recognizing recurring behaviors in the market's wild dance. While some swear by its predictive powers, others see it as akin reading tea leaves, intriguing but not always reliable. The root of technical analysis can be traced back to the late 19th centuries and early 20th century. However, the modern form of TA began to take shape in the early 20th century with the work of pioneers such as Charles Dow and Ralph Nelson Elliott. Some people mistake technical analysis with the quantitative trading approach that funds like Renaissance Technologies utilize to outsmart the market quite successfully. But the two are very different. Quantitative methods are like rocket scientists analyzing stock data with mathematical equations, while TA is more like fortune tellers reading tea leaves in price charts. Quantitative folks crunch numbers like math scientists, while technical analysts decipher market patterns like detectives solving mysteries. One relies on math wizardry, the other on chart artistry. But let's get back to the question, what do hedge funds and institutional traders think of TA? One of the most looked up to investors in the world, Stanley Druckenmiller, is famously using technical analysis in his strategy. In an interview back in 2023, he mentioned that his first mentor, Spiros Drelis, introduced him to TA and he found that it could be a very effective tool. But he's not the only professional investor who thinks that way.
What do hedge funds think of technical analysis?
Some of them love it and some of them hate it, and I think you have to really specify what you mean by technical analysis. If technical analysis means optically looking at the chart and looking at heads and shoulders and stuff like that, it becomes very difficult to test. You see, you might look at this today and see it's a heads and shoulders, and in 5 years' time you might see something completely different, maybe a cup with handle. What influenced you to make those choices, you can't determine, you can't test. So as long as the thing isn't, you can't write it down as a set of rules that, even a guy that doesn't speak English and sits in Mongolia can replicate, then it's not useful. So that's probably the way the group of people I belong to, the sort of systematic guys, would approach the subject. There's obviously another set of people that say, well, it's more of an art than a science. And hey, if they make money, who am I to deny another poker player's place in the sun? Yeah. So ultimately, that's the really great thing about trading. Regardless of how you manage to get that black number at the end of the year, that's ultimately all that matters.
It's very interesting what Gordon has said about being able to test the effectiveness of technical analysis. It's true that, for example, a chart pattern or price action can show completely different things over time or even on different time frames. For example, on the 4-hour time frame, you might see a bullish head and shoulders pattern, but if you zoom out or in, you see a bearish pattern. Also, as he said, over time the chart will look different. New patterns will form, so it's quite difficult to write down a set of rules for TA. But there are obviously people out there who make money with technical analysis or use it to help them determine good entry or exit points. So if people are making money with it, why wouldn't they use it?
Yes, but obviously hedge funds are very secretive organizations, and they don't really want you to work out or know what they're doing. I reckon that they are basically technically based, or significantly technically based. They'll have systems that they paid millions of pounds for programmers to design. And actually that also gives a sort of strange skew to the battle between the fundamental Warren Buffett guys and and everybody else, because the people who are successful at TA, you won't hear about. They tend to be in hedge funds. It's a bit like lottery winners. You don't hear about you don't tend to hear about lottery winners and how many people won, how much they won, because they tend to go quiet. So in that way, I think TA is much more successful than it gives the impression of being. I think that probably I'm on a mission, and I have been on a mission, firstly in the 90s, to sort of make technical analysis credible as a sort of alternative way of looking at the markets. I think that has happened. Basically, the job has been done. Every other person I know is now a TA expert, and they give me advice on what to do. So I presume that job is, the TA has become mainstream, and people don't look at you as if you're completely mad when you say Head and Shoulders or trend line break or something like that. So that's good. I think now the issue is actually just to try and perfect the actual science itself and get it so that the things that work are actually used by traders, not the things which are, and they're not actually just still sort of grasping at trying to make things work which don't work, and so on. So it's really trying to get to a new stage and maybe get things less complicated than people have made them, and really try and strip it down to something which is a practical way of trading the market. As I said, and I keep saying, most people blame technical analysis wrongly for their losses. It's normally the case that when they say they're using TA, they're not actually using anything. They're just using gut instinct or various other methods which have nothing to do with this form of analysis.
Zach Meir, a big advocate for technical analysis, also have an interesting point. Hedge funds are using this type of analysis, but they won't share with the public a strategy that actually works. People have no idea about the strategy of Renaissance Technologies Medallion Fund, yet since it has been established back in 1988, they made an annualized return of 66% per year, which is quite insane. As trading is pretty much a zero-sum game, if you found a winning strategy, you won't go out and tell it to the world, because in that moment it will become useless. Zach also expressed that most people, mostly retail traders, are not actually using technical analysis. They just look at the chart and use gut instinct. And when they lose money, they blame technical analysis for the loss. In all trading, technology made a big difference. First, the access to information with the rise of the internet, and also the access to the financial markets made it possible to basically everyone to participate on the markets. Nowadays, average investors can get information about financial assets very fast, and they can act on it immediately. But now it seems like with machine learning and AI, an even bigger wave is coming which can change the game of trading forever. The integration of machine learning and artificial intelligence into technical analysis and all trading has created a paradigm shift, leading to the arrival of formidable superheroes to the world of money management. Now you might be wondering, will these tools render human-performed technical analysis obsolete? Well, let's break it down. Sure, AI and machine learning have revolutionized how we analyze markets. They're like having supercharged sidekicks that can crunch data faster than a speeding bullet. These technologies have boosted our ability to spot patterns, predict market movements, and manage risk with laser-like precision. It's like having a crystal ball that helps us make smarter trading decisions. But don't say goodbye to technical analysis yet. While AI is a game changer, it won't change everything. See, markets aren't just numbers and algorithms. They are driven by human emotions and not always rational decisions. Fear, greed, and good old-fashioned gut feelings can still sway prices in unpredictable ways. The advancement of AI will probably make quant firms even more profitable and probably will provide them even more tools to outperform the markets. But as asset prices tend to move based on the underlying trend, using technical analysis will probably still provide a very good base to trade. So while AI and machine learning are transforming the way we analyze markets, old-fashioned trading will still be a strategy that you can profit with, although it will probably become harder and harder to win on the markets just by following the technicals. As we've seen several times before, with new tools, new opportunities arise. A lot of investors did very well because they were quick to adapt to computers back when they started becoming popular on Wall Street. I'm certain that investors somewhere in the world have found strategies and methods that are working because of the advancement of AI and machine learning. Having a strategy that is purely based on technical analysis might not be the best idea, as there are a lot of factors that can influence the movement of a security, but utilizing technical analysis to plan entries, stop losses, or to see that overall market structure can be a good way to look at it. Personally, for new trades, I like to look at the chart, look at trends, use the volume profile, find key levels, chart and candle patterns, besides looking at the fundamentals of an asset. And I believe everyone who is active on the markets should do something similar. If you hope to get a clear answer from this video about should you be only using technical analysis or not, I'm sorry, I cannot give you that. I believe you should use TA when investing, but also look at the fundamentals and possible factors that can change the movement of an asset. But hey, if you're a trader who only uses TA and you're successful with it, good for you. Please never stop. Thank you for your time.